We hear a lot about financial regulation, especially after, all the booms and busts over the centuries and certainly the more recent tremors. It's obviously fundamental, not just some bureaucratic exercise.
Absolutely.
But for our deep dive today, what are the specific problems, maybe the market failures or the ways consumers are vulnerable, that the UK's financial rules are really trying to fix? We're going deep into the UK's Financial Conduct Authority, the FCA, our mission, to really unpack what it does, how it got here, and crucially, how its work impacts you and your money. We've got some great source material giving a full picture of what the FCA is aiming for and what it actually does.
Yeah, and that's a really important way to frame it, because financial regulation isn't just abstract. It's the bedrock for individual financial security and, honestly, for the whole national economy.
Right.
If you look back historically, when regulation was maybe weaker, you often saw businesses becoming quite distant from their customers, sometimes, focusing purely on profit, maybe not so much on customer satisfaction.
Right.
And that led to trust breaking down, which is precisely why these rules became, well, essential. Is constant evolving effort against fraud, sure, but also against that sort of slow drift away from what's best for the customer.
So that's the big picture, why we need regulation at all. But before we get right into the FCA itself, what are these rules fundamentally trying to do? What's the core problem financial services regulation is there to solve?
Well, at the heart of it, the government's trying to create a level playing field, economically speaking, an environment where businesses can make a fair profit that's important, but not by, unfairly burdening people or committing fraud.
The Balancing Act.
Exactly. So the core aims, you could break them down. First, authorizing businesses, making sure they're legitimate, and ensuring they treat customers fairly. That's key.
Right.
Then making sure financial setups manage the risk of loss properly. Also, establishing clear accountability right at the top in these firms.
Someone's responsible.
Precisely.
Yeah.
And ensuring the people doing the actual regulated work are competent. Plus, overseeing ongoing training, keeping skills up to date. And finally, supervising everything, making sure firms stick to the rules and stepping in when things go wrong.
That sounds like quite a list.
It is. And while it might sound like just ticking boxes, the real insight is that regulation is fighting on two fronts. There's the obvious battle against fraud and bad practice, but there's also this more subtle fight against kind of complacency and the trust erosion that happens when profit becomes the only focus. It's dynamic, always adapting.
So it's about encouraging good business, but being really tough on protecting people. That does sound like walking a tightrope. What were the big moments, the shifts that led to the regulatory structure we have now?
Oh, the 2007 to 2009 financial crisis. Without a doubt, that was a massive turning point.
Right, the big one.
It really exposed deep failures, not just in how individual firms were run, but wider systemic issues too. Things like the huge PPI mis-selling scandal and the LIBOR rate fixing, where banks were actually manipulating key interest rates. Shocking stuff.
Yeah, I remember that.
These events just showed the old system wasn't up to the job. It forced a total rethink.
And that crisis didn't just highlight problems, it actually blew up the old structure, didn't it?
Yeah.
What happened to the FSA, the Financial Services Authority?
It was abolished, gone, primarily because of the Financial Services Act 2012, which kicked off a major overhaul, and then that was reinforced by the Bank of England and Financial Services Act in 2016.
So, new laws,
Yes,
new system.
completely new architecture, yeah.
Okay.
They basically created a new team of financial watchdogs after the crisis. You've got the Bank of England, think of them as the overall guardian, responsible for financial and monetary stability for the whole country.
Okay, the big picture view.
Then there's the Financial Policy Committee, the FPC. They're like the strategic thinkers looking out for those big system-wide risks, what we call macro-prudential oversight.
Spotting icebergs before we hit them.
Kinda, yeah. Then the Prudential Regulation Authority, the PRA, they focus on the structural safety of the really big players, the banks, the insurers, the investment firms that are so big their failure could cause major damage, making sure they're financially sound.
So checking the foundations are solid.
Exactly. And then the Financial Conduct Authority, the FCA, our main topic today, they're responsible for how all firms conduct themselves in the market, how they treat you, the customer.
Okay, so that split seems really important. Could you break down the difference between conduct regulation and prudential regulation a bit more? It sounds critical, but honestly can get a bit fuzzy.
It is absolutely critical, and yeah, the distinction is key. So prudential regulation, mostly the PRA's job for those big firms, is about the financial health of the firm itself. Does it have enough capital? Is it taking sensible risks? Is it likely to fail? Think of it like checking a car's engine, its brakes. Is it basically safe to be on the road?
Got it. Roadworthiness.
Precisely. Now, conduct regulation, that's the FCA's main patch, is about how that firm behaves, how it drives the car, if you like.
Oh,
Is it following the rules of the road? Is it honest with customers in the market? It's all about their behavior, their actions.
I see.
And the interesting bit is for many smaller financial firms, the FCA actually does both jobs. It checks their financial health and makes sure they're treating customers fairly. So it wears two hats for those ones.
Okay, that clarifies it.
Yeah.
So let's really zoom in on the SCA now. Given these distinct roles, what's its independent purpose? What's driving it?
Right. So the FCA is an independent body. It's accountable to the Treasury and to Parliament, but it operates independently. Its main strategic objective is pretty straightforward. Make sure the financial markets work well so that consumers like you get a fair deal.
A fair deal. Sounds simple, but probably isn't.
Indeed. And to achieve that, it has three core operational objectives laid out in that 2012 Act. First, protect consumers.
Yeah.
Shield them from bad conduct. Second, protect the financial markets themselves by boosting integrity. And third, promote effective competition, again, in the interests of consumers.
And I saw the source material mentions a new secondary objective from the FSMA 2023 legislation about international competitiveness and growth. That's interesting.
It is interesting, yeah.
Adding competitiveness and growth to the mix alongside protecting consumers.
Does that create tension sometimes? Does the FCA ever have to choose between encouraging growth and, say, bringing in tougher rules to protect us?
That's a really sharp question, and yes, it's definitely a balance they have to strike constantly. This new secondary objective means that when the FCA and the PRA too make rules, they also have to think about the impact on the UK economy's standing internationally and its growth prospects in the medium to long term.
It's about making sure the UK stays aligned with global standards, fostering an environment where firms can innovate and compete worldwide, but, and this is crucial, always within that primary framework of protecting consumers and market integrity.
So growth, but not at any cost.
Exactly. Responsible growth. When it comes to promoting competition, for example, the FCA looks at things like, are there unfair barriers stopping new companies from entering the market? Can you, the consumer, easily switch providers if you're unhappy? Are one or two giant firms dominating unfairly? Are firms actually focused on what consumers need? So, yes, growth is on the agenda, but it's meant to serve the broader goals.
Okay, so the FCA has these big aims, protecting us, keeping markets honest, fostering competition, and now boosting UK pillow's sake, essentially. That is a huge job. How do they actually do it? What powers, what tools does the FCA have in its toolkit?
They have quite a formidable toolkit, actually. They can step in and prohibit behavior they think is anti-competitive. They can also refer markets for deeper investigation by the Competition and Markets Authority, the CMA. They share powers there.
Right.
But one really powerful tool, I think, is their product intervention power. This isn't just about fines after the fact. They can literally step in and ban or restrict a financial product if they think it's harmful or just too complex for people to understand.
Wow. Okay, so they can actually pull things off the market.
Yes. Imagine a financial product they deem fundamentally flawed or unfair. They can say, nope, you can't sell that anymore. That's a very direct form of consumer protection, almost like a food standards agency for finance.
That's powerful.
It is. They also have the power of disclosure. They can publish warning notices about firms or promotions. They can take formal action against misleading ads. And importantly, they share responsibility with the PRA for overseeing the Financial Services Compensation Scheme, the FSCS.
That's the safety net if a firm goes bust.
Exactly. The FSCS pays compensation. And they also oversee the Financial Ombudsman Service, the FOS, which is where you'd go to complain if you have an issue with a firm that you can't resolve directly.
Okay, quite a range of powers. Now, the source material talks about the FCA handbook.
Yeah.
What is that exactly? Why is it so important?
The FCA handbook is basically the Bible for financial firms. It's the huge, detailed rule book setting out all the requirements. Think of it as the operating manual.
Right.
It's made up mainly of rules and guidance. The rules are legally binding, break a rule, and the FCA can take enforcement action, fines, restrictions, even shutting a firm down.
Serious stuff.
Very serious. Then there's guidance. Now, guidance isn't technically binding in the same way, But ignoring it, that's a really bad idea. It basically tells firms how the FCA expects them to meet the rules. If you ignore the guidance and something goes wrong, the FCA is likely to take a much dimmer view during any disciplinary action. It's like them saying, look, we told you how we expected this to be done.
So follow the guidance even if it's not technically a rule?
Pretty much, yes. And a really important part of the handbook is the high-level standards section. This sets out the fundamental obligations, things like the code of conduct for individuals, the basic threshold conditions a firm needs to meet just to be allowed to operate, and the fit and proper test for key staff. These apply broadly across the board.
And within that handbook, there are also the principles for businesses. That sounds like the real core philosophy.
Absolutely. You could say the entire FCA regime is built on these 12 principles for businesses, or PRI, as they're often called. They are the fundamental standards, the ethical baseline for how firms must conduct themselves.
Okay.
They cover essential ideas like acting with integrity, using skill, care, and diligence, managing conflicts of interest, and crucially, paying due regard to the customer's interests. And Principle 12, the new-ish consumer duty, is a really significant evolution of that customer focus. These aren't just vague ideals, they are enforceable principles.
All right, let's dive into that. Fair treatment of customers, TCF, and this newer consumer duty. This sounds like it should be a really big deal for, well, for all of us consumers.
Oh, it absolutely is a massive deal. The idea of fair treatment of customers, TCF, was already a core principle under the old FSA, carried over by the FCA as Principle 6. A firm must pay due regard to the interests of its customers and treat them fairly. Which sounds good, right?
Yeah, sounds reasonable.
But the move to Principle 12, consumer duty, which fully kicked in from July 31st, 2023, is a major step change. It's much more demanding. It doesn't just say treat them fairly, it says firms must act to deliver good outcomes for retail customers.
Okay, good outcomes. That sounds more proactive.
It is. It puts the onus much more squarely on the firms to think about the actual results for their customers, not just whether they followed a process or ticked a box. It's a really significant shift.
Can you give an example of the difference?
Sure. So previously, a firm might have argued it treated you fairly because all the charges were listed somewhere in the small print of a long document you signed.
Right, the classic small print defense.
Exactly. Under consumer duty, that's not enough. The firm now has to ask itself, even though we disclose the fees, is this product actually suitable for this customer? Is it likely to lead to a good outcome for them, given their circumstances? Does the customer actually understand what they've bought and the risks involved? It's a much higher bar. It's like a doctor not just handing over a prescription, but making sure you understand it, can afford it, know the side effects, and that it's genuinely the best path for your overall health.
That's a great analogy. So what does this fairness or achieving good outcomes mean in practice?
Yeah.
How are firms supposed to do this day to day?
Well, fairness itself is flexible. It depends on the situation. But firms have to show the FCA they're embedding this consistently. The FCA expects TCF and the consumer duty principles to apply right across the board from how a product is designed in the first place.
So thinking about the end customer right from the start.
Exactly. Through how it's marketed and sold, the advice given, how it's administered day to day, and crucially, how the firm deals with you after the sale, including handling complaints.
Okay, the whole life cycle.
The whole thing. And to make it more concrete, the FCA set out what were originally called the 6 outcomes for TCF, which are still highly relevant under consumer duty. These are the practical results firms should be aiming for.
What are they?
Okay, so 1, consumers feel confident they're dealing with firms where fair treatment is central. 2, products and services are designed to meet the needs of specific identified groups of consumers and are sold appropriately.
So no flogging complex investments to vulnerable pensioners, for example.
Precisely. 3, consumers get clear information before, during, and after the point of sale. You shouldn't need a finance degree to understand your insurance policy.
Definitely agree with that one.
4, where advice is given, it's suitable and takes account of the consumer's circumstances. 5, products perform as firms have led consumers to expect, and the service is of an acceptable standard. And 6, consumers don't face unreasonable barriers after the sale if they want to change product, switch provider, or make a complaint.
Right. No unreasonable hurdles. Makes sense. Now, the FCA's job isn't just about fairness in sales, is it? It's also about preventing financial crime. What's their role there?
That's right. Protecting the integrity of the financial system is one of their key operational objectives, and tackling financial crime is a huge part of that.
What sort of crime are we talking about mainly?
The main areas mentioned in the source material are market abuse and money laundering. Market abuse itself breaks down into two main types. There's insider dealing that's using confidential, non-public information to make a profit or avoid a loss when trading shares, for instance.
Using information others don't have.
Exactly. And then there's market manipulation. This is about deliberately misleading the market to distort prices, maybe spreading false rumors to drive a share price down so you can buy it cheap, or up so you can sell it high.
Okay. And money laundering, obviously trying to clean dirty money through the financial system.
Yes. And underpinning the fight against all this, firms are required to have really robust systems and controls, including, importantly, clear procedures for whistleblowing, so employees can safely report wrongdoing they see internally without fear.
Whistleblowing. Yeah, that seems crucial.
It really is often the way these things first come to light.
Well, we have certainly covered a lot of ground today, from the basic why of regulation right through to the specifics of the FCA's powers, the handbook, the crucial consumer duty. It's really clear the FCA has a massive role in trying to keep the financial environment fair and stable for you.
It really does. And understanding these different bits, like that split between checking the firm's health, the prudential side, and checking its behavior, the conduct side, or seeing how the rules have evolved towards this good outcomes focus with the consumer duty, it really helps appreciate just how much things have changed, especially post-crisis, and why it all matters when you interact with any financial service.
Absolutely.
And perhaps it leaves you with a thought to mull over. We see finance changing so fast, especially with technology, digital currencies, AI, and financial advice. How does a regulator like the FCA keep up? How might its role need to adapt again to make sure it can still deliver those good outcomes in a future that looks very different from today?